Without further ado, thank you for joining us, Steve, and take it away.
Well, I appreciate the opportunity to be here. I appreciate the title. These are community conversations that we're having, the third Thursdays.
Right.
And that's what I'd like this to be. I'd like this to be very much a conversations that I'm going to be doing the most of the speaking. Doesn't mean that there can't be some interaction, and I'll invite that at different times. So what I really would like to make sure is that as we discuss things, that there are things that you can apply. You have some paper in front of you, and so scribble some things down. And as you have questions, we'll address those. Dismantling the myths of investing is the topic that we're going to be unpacking in our conversation today. And there's a couple things that I want to acknowledge here. Yep. There's myths of traditional investing that can leave investors confused and frustrated with their results. And I hear it a lot in my profession. It's even if the markets have been generous, there's a lot of confusion and a lot of distrust, a lot of uncertainty, certainly not peace of mind when it comes to investing. And so one of the things that Belinda opened with, and I think is really important, is that for you to enjoy, when you're working, oftentimes you can out-earn some of the mistakes or the things that aren't working in your portfolio. But once you're not working anymore, there's a sense of vulnerability. My income depends really on what I've accumulated, and if that goes down, I'm not in a place where I can earn that back again. And so understanding how markets work to deliver returns, how markets work to deliver generous returns over time, I think is really helpful in creating peace of mind around your investing, but also allowing you to focus on the things that are most important in your life. We call that your purpose for money. And it's your purpose for money that's more important than money itself. And so my name is Steve, as Linda said. We were joking earlier, but I'll share with the people that just came in. I'll answer the question that's on your mind already, because if I don't, you'll just think about it the whole time. Everybody's thinking, how tall is Steve Andrew? I can admit it. I am 6 feet 10 inches tall, so compare that to your uncle or your cousin and decide if I'm taller or not. That's fine. But now that you could put that aside, we can kind of focus on what's at hand. My brother and I founded Cornerstone Wealth Partners quite a number of years ago. We work with clients all over the country now. We just recently crossed over to federal SEC filings now, so we work in enough states that's required, and we're excited about that. A lot of our clients have moved out of Michigan to different places in the country, and we're able to help them too. And so that's been a fun place to graduate from. The mythology of traditional investing can leave investors confused and frustrated with their results. And we're going to have some assertions that are going to guide our conversation. So the assertions kind of lead us through. And if this works here.
It's not going to work backwards, is it?
I think we'll try this in here. So see if I'm ambidextrous or anything like this. Common investing myths can lead people to make destructive decisions that can limit their growth and destroy their peace of mind. So the myths are destructive. Academic investing principles can give you access to a new way of investing. And then the third assertion that we're going to address is that you can apply these principles to build a better portfolio and have an opportunity to create peace of mind. So we're going to first talk about the myths. Assertion number 1. Oh, like this. They might just try this. There it goes. Common investing myths can lead people to make destructive decisions that limit their growth and destroy their peace of mind. So first, let's just evaluate what's a myth. A myth is a widely held but false belief or idea. So if you think about it, what are some myths that you're familiar with that have existed in the past? Pick up some obvious ones.
Retirement's financially scary.
Okay, that's one. Think of one that's not finance related, just a myth that's from the past that people believed in that was dispelled. Brian?
Bigfoot.
Bigfoot's a myth. That's right. That's excellent. That's a good one. Any other ones? A myth. The earth is flat. That's right. Interestingly, there are people that still believe that. And myths can be widely dispelled by science, by Magellan sailing around the world. I mean, those are things that dispel myths. That the earth revolves around, that the sun revolves around the earth was a myth. Let me get that right. Those are myths that the science of the day, and some of them were very destructive. So there was a day when you would get sick, and the medical profession thought that sickness was a toxicity of the blood, so they would bleed you to try to get you to get better, right? It killed people. It didn't help them, but it was the best that they knew, and that's the only thing they knew to do. The one that I have here is the myth that the devil would embody people. They call them witches, and those witches could influence people to take on whatever the devil wanted them to. And there were some young girls in the late 1600s that accused some women of that. There was the witch trials in Massachusetts, and people were killed. I think 150 some were convicted, and some of them were killed because as witches. That was a myth that was destructive, and it destroyed society. It destroyed people, and there are myths around investing that do the same thing, and that they're widely held that everybody does it. It doesn't make it true. That's really the point to get with a myth, and these are widely held. So these common investing myths, when you see them, you're going to recognize that, wow, these are common myths. Let me put them up here, Matt. The 4 myths that we're going to look at. The first one, stock picking. The second one, track record investing. The third myth is market timing. And the fourth myth is the cost of investing. So these are myths, and what we're going to look at is how we can dispel these or dismantle them. Yeah.
Are there any truths to any of these, or are they all myths?
We're going to go through them and take them apart, and then why don't you give me that afterwards and say, okay, what do I think about that? Because I would say that they're all myths. The first one being stock picking. What is stock picking? Stock picking is that someone has the ability to pick the best stocks based on a belief that they will do well in the future. Okay, pretty basic. Stock picking. There are some assumptions to stock picking. I'm going to use this grease board here. I need to turn that screen off a minute. I can do that. And I'd love to we're going to go through a little conversation here. I'd love to get somebody to volunteer to have this conversation with me so we can talk about it together. Who here owns a stock? You own a stock? You own a stock? Who would like to do an exercise with me just up here and just walk through the conversation together?
I'll do it.
You want to do it? Yeah. Great. Why don't you grab a chair here and we'll just talk through it together? It's great. And your name?
Bill Dykes.
Bill. Wonderful. I'm Steve. Good to meet you, Bill.
Nice to meet you, Steve.
Thanks for helping us out.
Yes.
And yep, just sit right here. We're going to have a conversation together. And all of you, if you want to just grab a blank page, some of you have done this exercise before, but grab a blank page and you can put a T on your page like this. And Bill Dykstra, Bill and I are going to walk through this exercise together. Now, there's some common assumptions about owning an individual stock, right? And one assumption is that that stock price, that the price of that stock is going to go up. You don't own it because it's going to go down. You own it because you believe it's going to go up. Is that fair?
Yes.
And you believe that's going to go up more than other stocks you could own because is that fair?
Yeah.
Yeah. So or the market as a whole. I mean, you didn't buy that stock just goes up a little bit. You believe it's going to go up more than the market as a whole does, or more than other stocks you could own. So you don't own Ford because you think General Motors is going to do a lot better.
Yes.
Right? You think it's going to be better. So those are some assumptions that we have about owning a stock or picking an individual stock. Is that right?
Yes.
What's one of the stocks that you own?
Target stock.
Target stock. And why do you own that?
Used to work at Target. And it was with a 401k, and I really went in.
Okay, so you used to work there,
yes.
Right? Any idea what stock price is right now, or close guess? Brian, you want to look it up a minute? Just tell me what the stock price is for Target. It doesn't matter a whole lot, but the reason you own this Target stock is because you believe it'll continue to do well.
Absolutely.
Absolutely. Okay, good. Great. We're not going to get into purpose a lot, but if you had to think about, Brian.
It's at 166.58.
I would ask.
Just 58.
I told you it's big.
166.58. I'll see if we can read that. Okay, great. just to connect really quick, there's things that you value, I hope, more than money. And we relate those to your purpose. What are some things that are important to you that money could resource for you? So a purpose for money that's more important than money itself. What are some things in your life that you say, well, these are really important to me?
Ministry and education.
So ministry, then education. And everybody, as you fill out your T-chart, what's important here is that the $166 a share and the shares that Bill owns is for something. And what I would assert is that the more money that Bill spends on ministry, the money that Bill spends on ministry and education is the highest value that money has. Now, he has to spend it on food and gas and other things too, that's true. But the more money he could commit to this, the money has its highest value when it's resourcing the things that are most valuable to us. And so I want to just acknowledge what those are. Now, so good. So you're doing great. This is wonderful. The target stock, that price is going to change.
Yep.
Sure. When more people want the stock, when there's demand, right, the price goes up. When nobody wants it, we call that what? There's more. So what makes the price change?
Less demand, it doesn't have, it has less value.
Yeah, supply and demand. So that's economics 101. Everybody agrees. Supply and demand will change the price. That's a change sign. Will change the price of that stock. Now, there's information that's generated every day, all the time, and the information affects supply and demand. When there's good information that comes out on target stock, it creates demand and people buy the stock. And when there's negative information that comes out, and there's two types of information that we're going to talk about with Bill today. One is knowable information, and the other is unknowable information. So write knowable and unknowable on your T-chart, like that. Everybody's writing that down. Wonderful. Now, Bill, there is some knowable information that you could know about Target. What are some things that's knowable that you could know about Target that would be a reason why you'd own that stock?
Sales.
Sales, perfect. Good. So you can know sales. What else?
How enthusiastic the employees are to work with the company.
So the employees, how many are there? What their ability to hire.
Absolutely.
There's metrics for that you can help. The metrics of how the employees are reacting to Target versus other places they could work. What are some others?
Enthusiasm of customers.
So customers, they track all those customers. They track how many customers are coming through the door, how much they're spending, how long they're staying there. All of those are tracked. Yeah. What else?
Come on, brain, kick in. Something was out of my mind. Community involvement. Target gives a lot back.
Okay, so generosity, it's community, giving.
Yes.
That's important to you. If you think of some more, we can keep filling the page, but these are all good.
Whenever I saw the Target stock go up, I got really excited.
Okay, so you get excited.
Oh, yeah.
Yeah. So,
and then I got other people excited, and I was telling people Target would match 5% of whatever we put in gross, and I would say, if you're not going to save, take 1%, because a lot of people don't save. So I try to encourage team members
so
to invest.
Those savings programs are marketing programs that they're doing, and that their generosity is something that appeals to people and works for them. So that's a marketing thing they're doing.
And this also allows employees to have money working for them 24/7.
Okay, so we're going to call this knowable information. We're going to call it facts, statistics, stats, and data.
That makes sense.
So facts, statistics, and data. Now, first thing, the facts, statistics, and data that you know about Target, does anybody else know what you know?
It's not a secret.
It's not a secret. So all of this is public information, right?
Yes.
Is there anything about Target that you know that nobody else knows?
No.
Okay, so everything that you know, everybody else knows as well. Who do you think, who's the person that might know more about target than anybody else?
The CEO and accountants.
I would think the C-suite, the CEO, the CFO, the CIO. I mean, all these corporate executives might know a lot. Does the CEO know what sales are going to be at the end of the year?
They have hope in their focusing their goals to achieve that.
We call that a guess. Is that it? Yeah. Okay, good. A guess. Is the CEO generally optimistic or pessimistic?
It depends on the company. At Target, they were very optimistic.
Typically so. I mean, they get paid to be optimistic, right? And so if they give a dour sales projection, it doesn't really work well for their bonuses and things like that. So the CEO might not be the most objective person, even though he has the most fact, statistics, and data. It's hard for him to know as well.
The economy or something.
Oh, that's right. And that's a fact, statistic, and data. How's the economy doing?
Yep, absolutely.
Right? There's a lot of fact, statistics, and data. When you start to think about it, there is a universe of fact, statistics, and data. It's not just what the economy is in the U.S. It's what the economy is overseas, overseas, because they import a lot. What's the logistics happening? Are bridges falling down in Boston where they have to get their, I mean, all of those things affect the price of the stock. Now, there's a couple things that are good to get here. One is, out of all the information that's knowable on Target, how much of it does Bill?
Very small amount.
Okay, so on a percentage basis, more than 1%, more than 50%, what do you think?
Say, there's so much out there you don't know about Target. I'd say probably 5%.
Say 5% is a very large number. How many employees do they have? Who is the CEO?
Yeah.
What were the sales?
Amen.
5 might be a little bit generous, don't you think?
Good point.
1% might be a little bit generous.
Yeah, good point.
Could you concede that maybe it's less than 1%? Is that possible? I mean, it's so less than 1% of Target is what Bill knows about Target, right? And you own it, and you're excited about it.
Yes.
Less than 1% of the information. That's fine. I'm not. That's good. The last thing I want to say about, a couple of things I want to say about this here. One, we call it theoretically knowable information. There's a reason why. There's been numerous examples. A couple of the more prominent ones. I just had a client in my office that I think worked for Arthur Andersen. Arthur Andersen was a CPA for Enron. And it just so happened that Enron had facts, statistics, and data. It was an energy company. If you remember what Enron, what happened is it was a growth company. It was growing like crazy. A lot of the employees had all of their retirement. They worked for them. They owned Enron stock. And come to find out, the facts, statistics, and data were a bit fuzzy. In fact, they were made up. And it was devastating to a lot of people. So we call it theoretically knowable. Because we assume that we know. A more recent example would be Theranos. Some people know what Theranos did. It was a bio company. They made wearable things that could track your blood pressure and things like that. It worked great until they realized that the data that they were promoting was all made up. So the product didn't work. And so it was a $9 billion company, and then it was worth nothing. So, that we trust the facts, statistics, and data, and assuming that they're correct, it's still, you own less than 1% of it. And the real main point is that Bill doesn't know anything that anybody else doesn't know. And all of this information is already in the $166.
Yep.
Right?
True.
There's nothing that Bill doesn't know that isn't. So everything that Bill knows is already in the price. So you can analyze this all you want, but Bill doesn't own it because it's 166 today. Bill owns it. You own it because it's what it could be 2 months, 5 months, a year from now, and your expectation is going to go up. But none of this information gives you that.
Yep.
Now there's also unknowable information. What are some things that isn't possible to know, that you couldn't possibly know about Target stock?
Lawsuits.
Okay, so there's lawsuits that might be coming up. The ones that are already announced are knowable, right? So I would say pending on some of those things, if they're already in the works, that could be something. There's competitors to target.
Yeah.
Right. So some of the things that competition is doing.
A pandemic that stops people from shopping at retail and
Yep.
has to shift.
So that the unknowable information that's already in the price of the stock, so it's already affected the price. The pandemic that's going to happen 3 years from now isn't in the price yet. But Bill is very excited about Target, right? So some people aren't.
Yep.
Right? That excitement has you shopping there more and more. Is it possible to gauge the excitement of people across the world?
No.
No. Everybody that buys from Target affects the price. Everybody that doesn't buy from Target. When you think about everybody that buys Target stock affects the price. Everybody that doesn't buy Target, they have their own biases. They have their own perceptions of Target. There's no way to gauge what somebody's perception or excitement level is for Target. In that context, how many people affect the price of stock in the world? How many people in the world buy Target stock, and how many people in the world don't buy Target?
Very few in terms of the world.
How many people don't buy Target stock? Billions of people don't buy it, and millions of people do. When you add those two together, you get about 7.5 billion people. The price of Target. Is that right? On any given day. Now that's so the reality is the unknowable information, the bias and perceptions are unknowable, and that some people are excited about it affects the price, and some people aren't, affects the price as well. Now, it's unknowable information. How much of the unknowable information can you know?
None.
It's not. So it's zero. So 0%. It wasn't a trick question. It was obvious. So it's because it's unknowable, you can't know it, and that's true. So in summary, so far, you own the Target stock and you're excited about it because of the knowable information that you know very, very little of, less than 1%, right?
Point.
And for the unknowable information, all of which is already in the price into the stock. You can't know it, but it's in there. So the perceptions, the biases that people have, there could be a major stockholder at Target that wants to go buy an island, or a social media company or something like that, and they're going to sell their stock. I mean, you can't know what the plans of people are. You can't know what those are, and all of that affect the price of the stock. And you don't know any of those things. And still, the price of the stock is going to change, right?
Yep.
So it's not going to. All this is already priced in, and so if this isn't going to make it move because it already did it, and this isn't because it already is in the price, what's going to make Target price change next week or the week after? If it's not these two things.
Even sales, I don't know.
Yeah, well, let's think about it. When I was a kid, I used to go around the neighborhood and I used to throw this paper at people's, and what do we call that?
Newspaper.
A newspaper. Very good. What's the root word of newspaper?
News.
News, right? If all the knowable information is already in the price, there's going to be new, not yet knowable information that's going to affect the price in the future, right? The information that's already knowable isn't useful. Does that make sense?
Yeah.
It's the news. It's the new information. So if today is April 18, if Bill, if you could tell me what the news is for May 1 of 2024, would that be helpful?
I would think so.
Who can predict the news accurately?
I don't know of anyone that can.
Nobody can. Who can predict the future?
Nobody.
Nobody can. If you can't predict the future, can you predict the price of Target? Not really. Does that make sense? So predicting the price of Target stock, predicting that it's going to go up, is really a guess. Is that fair?
Correct.
And a guess is much like a gamble, would you say?
Yeah.
And that gambling on target stock is really gambling on your purpose for target stock, which is gambling with ministry and education.
Is there a difference between this kind of gambling and going to a casino? They really would say.
I don't see it. I mean, unless you go to, if you go to the casino with your retirement account, it's the same, right? In some sense, I would think that this is worse because of what the money is for. I know people that go to Vegas just for entertainment. I'm not making a judgment call about gambling. I'm just saying that I wouldn't gamble with the money that's resourcing the things that are most important.
Absolutely.
So what there is to get here is that for all of the talk shows that are talking over top of each other about what's going to happen and all they're doing is trying to predict the future, and none of them can predict the future either. Not a government committee, not an analyst, not a PhD, none of them can predict the future. And so if a prediction is just a guess and you're guessing about stock, it's not an investment strategy that would engender confidence or peace of mind. Does that make sense?
Okay. Just so I can process this.
Please do.
How does a guy like Warren Buffett do so well with this understanding and lack of understanding?
Yeah, very good. I think so. Warren Buffett does a couple things. One is he owns companies. He doesn't buy a little bit of stock. He buys 80% of it. So NetJets, he buys a controlling interest in it, and now he's starting to manage. Now, people look at that and say, well, what about my own company? I invest in my own company. Investing in my own company is investing in myself, and I have never gotten a better return than the monies that I've invested in my own companies and the things that I've been involved with. So that's very different. Secondly, is if you look at the returns that Warren Buffett has gotten over 20, 30, 40, 50-year periods of time and compare that to the asset classes that those companies are in, a lot of them are small value companies in there. He hasn't outperformed the asset class. The asset class is very generous. Some of those will be averaging 12 to 14% over 30-year periods of time. That's pretty amazing. You can make a lot of money doing that for a long time. So I think Warren Buffett is not any different than what we're doing here, and Warren Buffett isn't also not predicting the future.
What is he doing?
Diversify.
Yeah. So it's I'm not trying to dismantle Warren Buffett.
Yeah.
And I don't agree with the stock picking portion of what he does, but he owns companies and he runs them really well, and he provides value in areas that people want and need, and that's what business does. That's the wonderful thing about business, is that we're investing in companies that are solving problems around the world. But I think for what the point is for Bill here is that the market is generous, and my point is that the generosity doesn't come from trying to guess which companies win and which ones lose, and that's exactly what we're doing here, and I think the absurdity is thinking that gambling with my retirement account honors my purpose for money or could even work long term. And so what we're going to look at here in a minute is why, what we call it is why it's so abjectly absurd. Anybody else have questions about this? My assertion is that stock picking can't possibly work, and it can't possibly work because all the knowable information is already in the price. You're not buying it for what we already know, or buying it for what we want to be true, and you can't possibly get that from here. So then you're just guessing, and guessing is gambling.
And you really do not know what's going to happen tomorrow.
Nobody does.
Right.
Yep. And it doesn't mean that there isn't value created tomorrow, and that a company as a whole. We're just saying you can't pick which companies are and which ones not. So, Bill, can we just all thank Bill for helping out? This is really good. This is great. Any other questions? Any stock picking doesn't work? We're gonna show the evidence of that here as well. Let me just after should thanks, Bill.
Yes.
Better just get this back on years. That can't possibly work. So this is so I think Bill, Bill brought up a good question. Why does it look like we can? Why does it look like Warren Buffett is, or Fidelity, or American Funds is? There's a number of ways that the financial industry makes it look like they're winning when they're not. And one really obvious one is survivorship bias. Now, what is survivorship bias? Survivorship bias is taking a look at the results of the companies that survived the last 20 years and ignoring the results of all the companies that didn't. I think of my kid going to college, and they come back from their first semester, and they've got an A, a B, and 3 Fs. And I'm like, what in the world? You're failing out of your first semester in college. And they're like, oh, no, Dad, I'm not failing. We just ignore the Fs and just concentrate on the A's and B's. The Fs. I said, I paid for those Fs. What do you mean? And that's what the problem is here. You'll see this in a minute, is that there were real investors whose money was squandered or gambled away, and that when they kill off funds, they erase all of their negative data for that. So when you look at Fidelity's history and say, hey, how have your funds done? Oh, they've done really well. Well, that's because they ignored all the funds that they had killed off. They don't bring that data back. This just shows what the funds were in 23, 24, all these years. There was one mutual fund in 1923, and then they kept adding new funds. So at the 1948, there was 4 more new funds, 116 funds altogether. They happened again. There was in 1961, the first event here where 33 mutual funds were killed off. 25 new ones were created. They had killed off 33 mutual funds.
Could you define fund?
A mutual fund, very good. A mutual fund is when a bunch of investors get together and they all put a little bit of money in. So Judy and Gary and Bill, they all put some money into this bowl, and then they hire a money manager to manage that fund of assets. And they give the money manager some qualifications. Hey, we want you to invest in real estate or in U.S. large companies, or, they give them, but the mutual fund manager is managing a fund of assets for a group of investors. Okay. And that's what a mutual fund is. Very good. I also use terms like the S&P 500. It's just the Standard & Poor's 500 largest companies. If there's any terms that you don't know, just stop me and we can discuss those. But what you see here is that they keep creating new mutual funds every year, and then all of a sudden in the 70s, 80s, and 90s, they start killing off more and more mutual funds. In fact, in the 2000s, let me get out of the way here. In the 2000s, thousands of mutual funds are killed off every year, and thousands of new ones are being created all the time. So if you think about it for a minute, why would they kill off a mutual fund?
Poor performance?
That might be. It probably wasn't because they were doing so well that everybody was making so much money that they said, hey, we should stop this. It isn't morally correct or something like that, right?
State.
This is the total number of mutual funds open as of 2022 was 31,000 mutual funds in 2022. The total number born since 1923 was 71,000. The total number killed off was over 40,000 mutual funds were killed off. Now, the negative performance data for all those mutual funds are erased. Now, nobody gets to see that. Or when you go to a mutual fund provider and say, how have you done? I see this happening all the time. The industry doesn't factor that information back in. In fact, the worst 200 dead mutual funds, this goes to Melinda's assumption, averaged a minus 87.14%. Cumulative total return for the worst 200. So if you started with 100,000 and ran it all the way to the end, you would have been left with 12.7 or 8%, something like that. And that's true. So the negative data gets erased. I had a mutual fund. It was a Franklin Templeton fund, and it didn't do very well. And I got a letter in the mail said, hey, we're merging this fund with another one, and pretty soon I had a different fund. And I could have gotten out, but I wasn't paying attention and just wrote it through. But if you take back, so what we did here is we took back, we did a survivor bias-free mutual fund database. So we brought back in all of the data from the mutual funds that were killed off and looked at what $100,000 in 1973 would have grown to in as an average mutual fund, including all of that negative data, 100,000 from 1973 to 2022 would have turned into $6 million. Pretty nice, huh?
Even including all of that negative.
Including all the negative information.
Incredible.
What's incredible is that people are satisfied with less than what the market can deliver. Because if you had put it into an index fund like the S&P 500, and just kept it in the S&P or the CRISP market, which is all of the different small, medium, large, it's the CRISP 1 to 10, the same $100,000 would have turned into over $13 million. So the point here is that the average potential loss to active stock manager was almost $7.5 billion. I see a lot of people that are happy with results that are less than what the market can offer. It's unfortunate. The market is very generous, but we oftentimes settle for less than what the market offers. Myth number 2, track record investing. Finding funds that did well in the past is a reliable method for indicating which funds will do well in the future. So that's track record investing. Now, I want to thank Bill for his help, but if nobody can pick stocks without gambling or speculating, then can a track record work? If the people that have a track record for beating the market are guessing, we call this a law of large numbers. If you have one person flipping a coin, right? We do this in some of our exercises. If one person flips a coin, you can flip. What's the chances of flipping a head? 50%, right? What's the chance of flipping 2 heads? 0.25%. There's a statistical chance for flipping 2 heads or 3 heads in a row. The chances of flipping 10 heads in a row is 0.1%. So it just goes down the more heads. Now, if you had a room with 100,000 mutual fund managers and they were all flipping coins, right? Is it possible that there will be a mutual fund manager that flips 10 heads in a row? Statistically, there is, right? There's going to be probably 10 of them. It's not that somebody has a good track record that matters. What the mutual fund industry is asking you to do is to pick the manager that's going to flip the 10 heads in a row in advance. Here's the point. If it was skill that had them getting the 10 years in a row with a good result, then what we'd find is that skillful money managers would improve their results the longer they were in the market. But the reality is that there are money managers that can beat the market in 1 year or in 3 years and 5 years. But the longer you go out, less and less money managers can do it the longer we go out. And so, hey, John, good to see you.
Hey,
So the myth is that for finding funds that do well is a reliable. Now, a track record investing is a super common way of picking investments. Anybody here have a 401k? Yeah. I don't know I don't know that there's a different way that people pick the allocations of their 401k other than looking at the track records that they give you when they give you the 401k. Oh, here's a 3-year, 5-year, 10-year. Look at this mutual fund did good for 10 years. I'm going to try that one. It's just the way that people do it. Now, when you're looking at a track record, would you want a long one or a short one if you were using track records to invest? Long one, wouldn't you? So the longer the better. This is a 10-year track record, and this is the 30 best mutual funds from 2003 to 2012. All right, so if you're looking at your 401k or if you're sitting with a financial advisor and saying, hey, what should I do? The likelihood is that when they show you their funds and what they could give you, it's very likely that one of those funds is going to be one of those top 30 mutual funds, and they're going to show you the 18%. And then what did the rest of the market? The S&P 500 did 8.8%, and less than half. And the CRISP, again, this is the 1 to 10, which is really the whole market from 1 to 10. The CRISP 1 to 10 did just under 10%, right? Now you're deciding which mutual fund to get into, and based on track records, you'd probably pick one of these, right?
Yep.
with the expectation that what's going to happen?
Just kind of correct.
They're going to keep doing it, right? Because you could have picked this one too, but you picked that one now, and it's going to grow more than these other ones, right? Because you didn't have to pick this one; you could pick the others. Now the thing to get here is that we didn't get the 18%, right? You were looking at stocks on January 1 of 2013, so you were looking back, and 18% had you picking one of those. Look, I'm staying away here. The next 10 years, those 30 mutual funds did 10%, and the S&P 500 and the CRISP did 13%, almost 14%. So you underperformed what the index is. Now, 3% over 10 years, is that a little bit of money or a lot?
What?
Yeah. And your expectation was you were going to do what?
Grow.
Yeah, you were going to do better than this, right? A lot of this isn't a matter of whether or not the stock market's going to go up or not, or an individual stock is going to go up. I'm not even concerned if Target goes up a little bit. I'm just saying we're trying to get the best returns the market has to offer over the time that we're going to be in the portfolios. So the track record here is the track record didn't give you that, and it can't possibly if mutual fund managers are getting returns based on skill, it would be likely that 10 years would show themselves repeating that. But empirically, as we look at it over and over again, what we find is that on any given year, most mutual fund managers, oftentimes 85% of them, underperform the indexes that they're trying to beat. So if a mutual fund manager is in the space of U.S. large, their returns are less than what the large asset class. And when you go further out, when you go 5 years, 10 years, 20 years out, less and less and less mutual fund managers, not more and more. So we're going to look at that a little bit later, but that's track record investing. And what Bill helped us with is that if stock picking can't work, then track record investing can't work, and the empirical evidence shows us that. That's a myth. This is Burton Malkiel. I've become increasingly convinced that the past records of mutual fund managers are essentially worthless in predicting future success. The few examples of consistent superior performance occur no more frequently than can be expected by chance. So that the statistical evidence aligns itself with just the pure chance of enough people trying, that hundreds of thousands of mutual fund managers trying to beat market, that some of them do doesn't prove anything. It just says, hey, some people do get lucky. So that's myth number 2. Number 3, market timing. What is market timing? Yeah, Bill.
I don't believe in luck, but it sounds like this is more about luck than anything else.
Track record investing is?
This whole thing, and I'm just trying to grasp this. It sounds like there's a lot of luck.
Okay.
Is that correct?
Well, I think
in the big picture.
Yeah, I think if you're trying to get lucky with your retirement account, right? I don't call it luck. I call it gambling, speculating, guessing, right? And then I would say, hey, if you're lucky, people do. I mean, I know people that got into cryptocurrency and got out before it crashed. I don't call that skill.
Yeah.
I call that luck, right? I say take the win, but don't go back.
Yeah.
Right? You already talked about stocks that you won, right? I'm not suggesting that you can't get lucky on target stock. I just don't think it's a strategy.
Yeah.
It's not something I would feel confident about when I'm looking at a retirement and saying, hey, can I feel good about what the future has when I feel like I got lucky? And I think there's a lot of people that come to me that say, I did well, but I have no idea why, and it's likely I was just lucky. I got into this. I helped my cousin out, gave him some. I invested some money with him, and this company took off, and it worked. It was purely luck. I mean, there's so many companies that failed. Does that make sense?
Yeah.
So,
Thank you.
So market timing, again, it's someone can predict when the market or a segment of the market will go up or down and make trades to capture the upside without suffering the downside. If you knew when the market was peaked out and got out, and then you knew when it bottomed out and got back in, could you make a little bit of money?
Yeah, sure.
A ton of money, right? And there's people that think they can guess when the market goes up and down. Now, an example of market, a lot of people say, well, I don't do that. If you're overweighted in cash, so if you're sitting on a lot of cash because you just want to wait till after the recession hits, there are so many people predicting the recession. Did anybody know there was going to be a recession this year? I mean, certain that there was going to be a recession this year? I mean, you wouldn't, if you look back at the news from 2 years ago,
It was going to be.
absolutely, the Fed was wrecking the economy. I mean, the smartest minds in the world were saying that we're bound for a recession. We just don't know if it's first quarter, second quarter, or third quarter of 2023.
Mm-hmm.
Were they right?
No,
They still have their jobs? Yes.
probably.
Are they still predicting? Like crazy, right?
Right.
And we're eating it up. We're paying for it. We're the most predictive, addicted society in the world, I think. So, but market timing is an example of that. People are just sitting on the sidelines waiting for the market to go down so they can get in. And they have no idea if the market's going to go down or going to go up. Burton Malkiel again. The lesson about timing is not only that you not know when to get in, you also don't know when to get out. And when you market time, you got to be right twice.
Right. Sure.
You got to know when to get out and when to get in. And nobody, and I really believe this, nobody can do that without luck. And how often are you going to be lucky? Why is it so hard? I was talking through one of my, we had a bracket at the NCAA, right? You know how many brackets for the NCAA tournament, the March Madness final, you know how many brackets are submitted? What's that?
Like 300.
Yeah, they estimated 60 to 100 million brackets are created and submitted every year. 60 to 100 million.
Well, you don't brackets.
Brackets. So you're picking the winning and losing basketball teams for the March Madness NCAA basketball tournament, right? There's 66 games on the bracket. 66. Not a lot. And you just have to decide yes or no, win or lose. You don't even have to guess the score. You just need to guess win or lose. It's a lot easier than picking stocks. And 100 million people submit a bracket every year. How many of them win? 0. Since 1985.
Wow.
Wow.
49 is the highest, is the closest they've ever got. Warren Buffett and Dan Gilbert put up $1 billion for anybody that can pick a perfect bracket one year. I think it was 2015 or something. And their money was safe. I don't know why they did it, but they didn't lose a dime. So it was,
So I wish I'd known that.
and that is a very simple. It's just a yes or no. The stock market is so much more complex than that. 25,000 companies in 70, 80 different countries. It's now. This is just a simple example from 2003 to 2007, 2022. For that 20-year period, there were actually 5,000 trading days. 5,000 days that you could be in the market or out of the market. And so if you were in the S&P 500 for all of those days and you had $10,000 from beginning to end, your investment would have grown 6.5 times, $64,000 you would have had if you were in the S&P 500 for all of the 5,000 days. Now, let's say you were out of the market for 10 of the best days that the S&P 500 had. You would have been less than half. That's 10 days of 5,000 that you weren't in the market. 10 of the best days of the market that you weren't in. If it was 20 days to be 17, it was 30 days, your 10,000 would have grown to $1,752. And that's just 30 out of 5,000 trading days. Now, people get in and out of the market all the time. They usually get out of the market when? Before the market goes down? No, statistically, they go down afterwards. So people didn't get out of the market in February of 2020, did they? But $80 billion left the market in April of 2020. What was the difference between February of 2020 and April of 2020? What happened in March?
The pandemic.
The pandemic hit.
30%-ish down in the market, right?
Yes, they get out at the wrong time. Now, Why did they get out? Because they thought it was going to rush back up again?
No.
No. But what happened?
It rushed
It rushed back up again, right? Some of the best days in the market follow what?
Or the worst.
The worst days. Now, if people are going to be out of the market, oftentimes they're out of the market until they're convinced the market is back. And what have they missed? They missed some of the best years. 19.
That happened this week. I mean, I heard, one day we lost Dow, S&P lost 400 and something, and the next day gained 500.
That's right. So it's just, we don't watch it day by day, but if you did, it'd go crazy, wouldn't you?
Oh, I didn't have.
It's mind-numbing. But that's it. Timing the market is impossible, and you have to be right twice. And so Burton Ocula is correct. There's more that we could say about this. This is an interesting research company. Dalbar Research doesn't research what mutual fund managers make. Dalbar Research what the investors inside the mutual fund makes. Now that's a very different thing. If you think about it, if a mutual fund posted a 20% return for 5 years in a row, and then for 5 years in a row they posted 0% returns, so they have a 10-year return history. What's the average for 10 years? 10%. Not bad, right? What shows up on your mutual fund statement when you're looking at track record? 10%, right? 10-year track record, 10%, right? So some people look at saying 10% for 10 years, that's pretty good. I'll go for that, right? Now, what did the mutual fund investors inside the mutual fund get? Because Morningstar didn't rate them till after 2 or 3 years. The 4th year and the 5th year, they are starting to get 5-year ratings. This mutual fund has gotten 20% returns for 5 years. Isn't that great? And people rush into the mutual fund. Did they get the 20%?
Mm-hmm.
No, they got the 0. So a mutual fund, what Dalbar does is they research what are the returns for the mutual fund participants, the ones inside the mutual funds. What they found is that over this 30-year period from 93 to 2022, the S&P 500 averaged just under 10%. The average Dalbar investor averaged just under 7. So they're underperforming the market as a whole. And what's also really important here is the average holding period for the investors. And they've done these research studies for many, many years, almost 30 years themselves. The average holding period for that 30 years, the average mutual fund participant only holds mutual funds about 4.25 years, meaning that they're chasing after the next thing. And so they're getting out of something and getting in something else. And not only mutual fund, not only individual investors, but also their mutual fund managers, especially in the commission environment. So when mutual fund managers make a commission on mutual funds, they get paid when they sell the mutual fund, but they don't get paid again until they sell the next one. And so mutual fund managers or financial planners that sell mutual funds on a commission can oftentimes find it hard to be objective, especially if somebody comes in and says, hey, this mutual fund's doing awful. And they're like, well, hey, here's a good one. Why don't you try that one? Okay. Do you want to try? Yeah, I want to do that. Yeah, sell that one, move that one. Well, they're asking for it, but they get a commission for it as well. So that's what the Dalbar study. Oh. So stock picking, market timing, and track record investing, all of these are forms of active management. So that's really what we're saying here is that active management doesn't work. It doesn't work for all the evidence that's there, but if you just look at it logically, you start to realize that, wow, it can't possibly work. And then there's one more myth that we have here, and that is systems. The cost of investing. The myth is that what you don't see can't hurt you. So if I can't see it, it's not a problem. There's two things I want to. There's a bid-ask spread. There's a lot of people that don't understand what this is. If you trade individual stocks, you begin to figure this out pretty quick. And then mutual fund expenses. Mutual fund expenses are the published expenses that the mutual funds publish for you. What's interesting is the bid-ask spread is not included in the published fees. And a lot of people say, well, it doesn't really matter. It does. What is the bid-ask spread? What is a bid-ask spread? Bid-ask spread is that for every company that's sold, there's 2 prices. People don't realize that. So if you wanted to buy 100 shares of a particular company, say John Deere, or say you wanted to sell 100 shares, you wanted to sell 100 shares, and And just before you sold it, you realized, oh, maybe I don't want to sell it. I think I want to buy 100 shares instead. There's a price for selling it, and there's a price for buying. It costs more to buy the stock than you get when you sell it. And what that is the commission that the market maker makes. So there used to be a day when you see the cameras on the floor of the New York Stock Exchange, and there were people bidding for all this stuff going on. Each one of those towers was a market maker, and the stocks were being sold on the platform of a market maker. And the market maker makes money every time there's a trade that happens. And it doesn't matter if you're an individual investor. This has nothing to do with the commissions. So if you have a broker that charges a commission, that has nothing to do with your commissions. This is charged every time, and everybody pays it. Individuals, institutions, everybody pays the spread. The spread is different based on different market segments. So the spread for U.S. large is the lowest. This is 5 basis points, so 0.05%. 5 basis points, 14 basis points, and 29 basis points for small. What the spread is determined by how much trading is happening inside of that. So if you see sometimes there's a trade free where you can trade for free on certain platforms. Many of those platforms are playing in a small space where they're making money on the trades just through the spreads that are happening. But this is true for the U.S. The non-U.S. is somewhat similar, and then emerging markets, which is just a more difficult market to trade in. And so it's not a big wonder that a lot of the actively managed mutual funds are actively managed in the large space, because if you have this cost every time you get in and get out, it adds up to a lot of money over time, and it's a lot harder to make up the cost of trades when you're in the mid or small cap space.
Yeah.
So this is Charlie Ellis, an author and an educator in the space. The key question under the new rules of the game is how much better must the active manager be to at least recover the cost of active management? The answer is daunting. There's been a lot of research as to what it might be actually. It's really hard to track because there's so much trading going on all the time. It's hard to keep up. But they estimate anything from 1 to 11 or 1 to 4% is lost in active management. So if the market generates a 10% return on its own without any active management, all the trading, somebody that's trying to beat the 10% would have to overcome anywhere from 1 to 4% of returns to get above a passively managed mutual fund. When it comes to cost, what you don't see can hurt you. Costs have a direct impact on your real return. I don't think that's new information, but it's good to get. So the myth: stock picking, track record investing, market timing, and the cost of investing. Those are the myths. And I don't know if you guys are thinking about this. For most people, that's all investing is.
Then
For most people prior to, say, 12 or 1300s, they thought that if you sailed far enough, you could fall off the earth.
Mm-hmm.
Right? Galileo wasn't. He didn't get the Nobel Prize for announcing that the Earth revolved around the sun. In fact, I think he got excommunicated or something. He was not popular, and there's a lot of people that were very angry about it. And there's people that react, and you may as well. But it's just worth. My goal is to interrupt maybe some of the assumptions that you have about what investing is.
Interrupt, you mean make us think?
Make you stop and think. Yeah. Question your assumptions. Exactly right. And before you leave, what I want to do is identify, look at an approach based on science, that there is a way. Markets are generous. What I don't want you to get, some people walk away from and say that Steve hates mutual funds. That is not true. Steve loves mutual funds. I think there's a way to diversify inside of mutual funds and ETFs that's very efficient and could work really well. I just think mutual fund managers abuse the funds that they're responsible for. There was a day when the mutual fund hired the manager, and if the manager was failing them, they would fire the manager. Not so much anymore. Managers control the funds, and if you don't like it, you can leave. But managers kind of rule, and I think it's inappropriate. So assertion number 2 is that academic investing principles can give you access to a new way of investing, and I think a new place to stand, new world to look at investing through that really provides peace of mind and confidence. And what we're looking at here is there's a number of academics that Art Laffer is. He was on the economic board for Ronald Reagan. Still writes a lot of books. Older, but still very active. Lyman Ott's a mathematician. Has written textbooks, and then Samina is an analyst that works for Dimensional Fund Advisors. And then these are psychologists. So there's a psychology. What we're talking a lot about today is the allocations for portfolios, the technical side. But I just want to acknowledge that that there's reasons we do things that don't work, and we do them over and over again. We talk about this in the workshop too, is that losing weight is not difficult. Very basic level, it's just eat less and move more, right?
Right.
People spend billions of dollars trying to lose weight, and that's all it takes. But there's reasons why I eat that have nothing to do with losing weight or being healthy. And there's reasons why you invest, the fear of missing out. A recency bias. Do you realize that we're going to look at portfolios here in a minute, but you know, you put a lot more information, you weight the information a lot more strongly for recent information than you do for information from 20 or 30 years ago. But the markets don't. And the market looks at all information the same. So this is the Matson Method. I should do my clicker up here and go back here. Okay, it's based on 50 years of sound economic investing and a disciplined approach that seeks to capture market returns while managing market volatility. What we want to get is that the markets are generous. We don't need to beat the market. What we need to do is we need to capture the returns that the market have. And once you get that, there's a lot of peace of mind in recognizing the market is consistent and I got it. So it's user error. So the 3 things I want to look at: efficient market hypothesis, modern portfolio theory, and the 3-factor model. These are the 3 things that go, the 3 principles, academic principles that inform, I think, a very disciplined and healthy market approach. Efficient market hypothesis. Eugene Fama came up with this. He's still active today. He's getting older, but University of Chicago. He won the Nobel Prize in 2013. But he informs a lot of the theories and things that we apply in how we build markets. What efficient market hypothesis simply says: in a market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. So when Bill's buying Target, he's looking at 166 and saying that's cheap. I think it's going to go up. What Eugene Fama says is that what's Target worth today? It's worth whatever the market's giving it today. And that markets are efficient at prices in all the knowable information immediately, far better than anybody else can do. So if you believe that the markets fail, and just put this right through here, the market price if you believe that markets fail, the market fails to price goods and services efficiently. It's possible for some individuals to identify in advance which prices are inaccurate. Underpriced or overvalued markets can be forecasted or predicted. Managers seek to increase returns and avoid losses by taking advantage of stock or market mispricings. And then people with this view use traditional investing approaches. So traditional investing approaches assume that markets fail, that markets aren't efficient, and they would hold those beliefs. Or you could believe that free markets work. Free markets work. Yeah. The free market is the best determinant of market prices based on supply and demand. So that supply and demand in a free market is the best determination of what something is worth. All available information is factored into the current price immediately. Only new and unknowable information and events change pricing. So new and not yet knowable. I mean, this is information that hasn't yet come out. You didn't get this newspaper yet. The randomness of the market makes it impossible for any individual or entity to consistently predict market movement. And people with this view would utilize free market investment strategies. So really what we're doing is saying, and this is one of the best, I think most important slides here, is beliefs dictate action. Just gonna put these up here. There's two beliefs, and you just, in deciding, I think of all the slides we have, this is probably the most important one. Decide where you are. If you believe free markets work, then focus on capturing market returns, eliminate traditional investing strategies like stock picking, market timing, track record investing, utilize asset class or structured funds, diversification eliminates a lot of the risk in the market. Identify your risk tolerance, so how much risk is good for you. It's different for everyone. And then work with a financial coach who shares your market belief and helps you pursue your investment objectives. If you believe markets fail, you would be frustrated by them. So you'd focus on active management. You'd pursue traditional investing strategies like market timing and track record investing and stock picking, right? You'd stay connected with multiple sources of financial information and read as much market information as you possibly can, right? If Elon Musk gets a cold, you have to decide if you want to hold on to Tesla, right? Because what if it turns into COVID, and what if he doesn't recover, and what's going to happen then, right? But you need to know that right away. And then you work with somebody who thinks that way and believes that way. And that's your option. That's not mine. It's not where I find peace of mind or where I find value in working with clients. But that's really the choice that there is to make between the two. But if you choose that free markets work, there is a way. Modern portfolio theory is component number 2. Harry Markowitz in the 1950s theorized this. He proved it in the 1990s with computers were strong enough to compute. Won the Nobel Prize for economics that year. What modern portfolio theory says is that it argues that it's possible to design an ideal portfolio that will provide the investor a maximum expected return by taking on the optimal amount of risk. And if you Google Markowitz's last name, you'll get this graph. It's called the Markowitz efficient frontier. Everybody has known that if you take more risk, you'll get more return. And so there's an axis that goes straight up like this. What Markowitz discovered is that by combining assets, let me see if I'm going to go through. By combining two assets together, what you can do is, as investment A and investment B both provide a positive return. But what he realized is that they don't provide the returns at the same time. And so when you own both of them together, what you can do is you can eliminate some of the volatility and still get the returns for that. And so that there are different asset classes that provide different levels of risk is true, but you don't need to take all the risk when you diversify. And that's an academic principle. Let me see if, it's turned a little bit, so it's almost so. I'm going to skip. I'm just going to talk to 3-factor model, address that, and then and that'll give you the point of what we're looking at. The different asset classes. The 3-factor model says there's 3 factors, and what Eugene Fama won the Nobel Prize for is that he identified 3 places where the market pays premiums. So if the market as a whole provides a good return, you just own the whole market, right? Well, what Eugene Fama proved mathematically is that there's certain aspects of the market that pay a little bit more because a little more risk. Now, it's not everything, but one of those areas is that stocks pay a premium over bonds. Now, this isn't a surprise, but the gross return for stocks since 1926 was over 10%. T-bills was just over 3%. You get a premium for the risk in the stock market for owning stocks. Now, you can see that, and you can see that here. There's a premium of almost 7% for owning stocks over bonds. Now that is a theory. That's a hypothesis. What this shows is that that there was data that behind it. Because I get accused all the time and saying, Steve, isn't that a track record? You're looking at a track record from 1926 that says that stocks outperform bonds. And I'm saying, no, it's not a track record. It's a data set. And when you're looking at a tracker, you're looking at one 5-year period or one 10-year period or one 20-year period. You're looking at 1,153 one-year periods. Now you could say there hasn't been that many periods in the market, but there has. If you look at one-year periods from January 1 to December 31, from February 1 to January 31, and you just rolling 12-month, when you do rolling periods, you get 1,153 one-year periods. Now, the reason that's helpful is because a one-year return from January to December is in January 2020 to December 2020 is very different than April 2020 to March 31 of 2021. So what they're doing is they're pulling out as many data sets as they can. There's 925 20-year periods. And how many 20-year periods was the stock market worse than the bonds or cash? None. 100% of the time, the stock market outperforms cash. So now you can get a CD for 5.5%. That's fine if you're going to use your money next year or the year after. But if you're investing it for retirement, do you really want money in cash? You really don't. Now this one is the equity premium. So stocks outperform bonds. I don't think anybody came here thinking that that wasn't true, right? But they did the same thing for the size factor. Small companies outperform large. Same thing. There's a more than 1% return. Now there's a lot more risk there as well. And so we diversify away some of that risk through combining asset classes. But they did the same thing. In one-year periods, now you're already in the world of stocks, and you tilt the portfolio towards small because over half of the time, one-year periods, they're better. 10-year periods, 63, 20-year periods, 84% of the time. The significance here is that if it was chance, if it was purely random, when you go 3 years, 5 years, 10 years, it wouldn't go up. It'd do what? It goes down, flipping coins. You can get 50% success rate flipping coins. It's just when you go out 10 flips, it doesn't go up, it goes down. The significance of this is that you can have a lot of confidence in a portfolio when you realize that statistically, the chances of getting the premiums of small is very high. Yeah.
Would you mind how much what's small?
Very good. Boy, so glad you asked. There's large companies. Those would be like Teslas and Amazon and Facebook. Those are the largest companies. So we look at the 500 largest companies in the S&P 500, and that's their capitalization. That's how much capital that company is worth. And then small companies are just smaller than that. So there's large companies and small. Big ones, little ones.
So you name so small.
Steelcase would be a small company. It's any company under $2.5 billion. The large companies are 100 billion, or it's just much larger than that. So I forget what the difference, but that's they measure it by capitalization, and they study how small does it have to be in order for it to qualify for the premiums to show up. So there's a lot of research that goes into that, but very good question. Large or small. The next one's going to be a little bit harder, and that's growth and value. Value companies are riskier, and they provide a higher return than growth companies. So a growth company for Judy, a growth company would be a company that everybody is excited about. Everybody's excited about Amazon or Tesla, or these are companies that people believe in. They've got really great products. Everybody likes them. A value company would be somebody it's boring. I just don't know where they're going to be 10 years from now. And yeah, they're profitable, but you just don't know where they're going. And so there's not a lot of confidence. Sometimes there's a problem. The FDA didn't approve their drug, or the CEO's on the front page of the paper for a bad reason. So value companies are risky because they don't know if they're going to make it. But when they do make it, their stock just goes through the roof. So you don't have to be right at a lot of value companies to win. But again, the same thing is true. The same thing is true. 1 year, 5 year, 20-year periods, 95% of 20-year periods, value companies outperform growth companies. So when we build a portfolio, what we want to do is we want, and there's places where that isn't true. So some people think real estate is really good. I should be in real estate. Well, when you look at real estate inside of the market, you realize that there is no premium. The market doesn't pay a premium for real estate. The premiums in real estate show up in small value companies. So we don't want to tilt your portfolio to a risk factor that doesn't provide a reward that we can, because there's lots of risk in the market. You can own one company, that's a risk, but there's no reward for that. If you want to own Target, own it inside of an asset class. The math and science is intriguing. The more that I learn about it, the more I realize, wow, it's absurd to think that somebody could outperform the market over time without luck, and that there's so many aspects of the way the markets work that make it even harder. I'm not going to go through all of them, but academic investing principles can give you access to a new way of investing, and then we're going to apply that. This just shows the Dalbar results that we looked at before, that most investors get less than what the market offers. And this is what the S&P 500 did. So $100,000 invested in 1990 turns into 2.1 million. I had a client on Monday that had invested $5,000 in the late 70s and then forgot about it. And now it's 160,000. She said, boy, what if I had invested 50? I said, yeah, you got $1.6 million. We don't sometimes believe these numbers, but so many people got out in 2008 or that pandemic year. There's a lot of, it's hard to stay disciplined, especially the more you watch the news, the harder it gets. So if you add it, so this is where the S&P 500, the 2.1 million, it looks good, right?
It's just not bad.
It just happens to be the lowest performing asset class since 1990. That if you had a U.S. large cap value, you would have been here. Small cap would have been here. Small cap value, you would have been up here. So the point is that U.S. large is where everybody's at. And U.S. large has its good years. There's been, in the last 5 years, at least two of the last 5 years, the S&P 500 was the highest performing asset class. That's okay. We just know that statistically that doesn't repeat itself year after year. And we're not trying to guess. We just recognize that if you own the whole market, we own some S&P. We just tilt our portfolio to the small and the value. They apply these principles to create globally diversified portfolios. This is the fixed income. These are, we do this with the bonds. Here is the U.S. microcap, small cap value, small cap, a large cap value, a large cap again, large companies that are distressed, and then large cap companies that are growth companies. So these are the different asset classes that we own inside of a diversified portfolio in order to diversify wealth. And then internationally, we do the same thing. These are the international asset classes we do. By combining asset classes, we reduce the risk. So all those risk factors don't show up as prominently, and you still can get the returns that are available in some of these asset classes. I'm running through this kind of quickly toward the end, but I think you're getting the point, what doesn't work and what does. The diversification is 78 countries, over 25,000 holdings. That's diversified. So I get a lot of different questions, and you may have those as well. I'm going to be here for a while. The path to investing, peace of mind, is not paved in mythology, but in science and academic investing principles. That the science is very good. The things that Eugene Fama, Harry Markowitz theorized and then proved in the 90s and in 2013 get vetted every year. People say, yeah, well, that doesn't work, and they'll prove it, and they look at it again. Okay, it still holds up. It still holds up. When the tech bubble burst in 2001, 2, and 3, or when the financial crisis hit in 2008, people say, well, hey, it didn't work. Well, actually, it did. The technology companies that were large and small acted like large and small companies. The value companies acted like value companies, growth like growth. So our assertions here that we talked about earlier, common investing myths can lead people to make destructive decisions that limit their growth and destroy their peace of mind. When I see people anxious about the markets, that worried about what could happen, in my mind, I know, okay, you've been drinking a lot of Kool-Aid from from the traditional investing jug. Academic investing principles can give you an access to a new way of investing, and you can apply these principles to build a better portfolio and have an opportunity to create an investing peace of mind for yourself. And that's really what our goal is. I want each of you to resource the things that are important to you, but then to live in a way that you can actually take action there, that you're not sitting there in front of your computer screen worried about whether or not I should be buying or selling, or whether my broker is doing what they're supposed to be doing, and then go out and live your life for everything that God intended you to. There may be some questions here. I'd love to answer those. I just want to acknowledge the time. So if you feel like it's 7:03, if you feel like you have to go to Arizona or wherever you're going, don't hesitate to step out. But if you have some questions, Bill just raised his hand. I'd love to answer those. Go ahead.
What I think you talked about, who don't have retirement money in cash, something to that effect.
Oh, no, I said if you're market timing. So some people say I'm not market timing, but they may be holding on to more cash than they need. So I'm just afraid to put the cash in the market right now. That's a form of market timing. That's all.
What percentage of people have, in particularly that are retired, have their money in cash instead of less liquid?
Less liquid than cash?
Yeah.
Cash is pretty liquid.
I know it's liquid.
Yeah. So I don't know what the percentages are. I talk to a lot of families that are, questioning what to do next. And I'll frequently see people that are, they may have a, $5 million net worth and $2 million of it is in cash. And I'm like, what's this for? It's not an emergency fund. And they're like, well, we just never know what could happen. And in case the world came to an end or something. And then there's all kinds of theories about, what if the U.S. dollar wasn't the international currency anymore, or things like that. And there's a fear about things like that. And I think it leads us to do things that are sometimes irrational, and the fear itself isn't always rational. But there's ways that people can they feel like they're placating some of that through just holding an excessive amount of cash. It doesn't occur to me that works. The tendency is that they're no more. They don't feel any better about where they're at with the extra cash either. Secondly is, I think investing in entrepreneurs and businesses, people say there's a lot of problems in the world, and I have to agree.
Yeah.
But the beautiful thing about that is that entrepreneurs solve problems.
Yeah, they do.
And they get paid for it. And so when I put my money with an entrepreneur that's solving problems, I get to share in that. And so that there are a lot of problems gives me a lot of hope for investing in the future. Secondly is that if the U.S. dollar isn't the international currency anymore, businesses are going to still figure out how to sell shoes and cars and things like that, and they'll do it with whatever currency they need to, and they figure these things out. People that say, well, when that happens, this is going to happen and that's going to happen, they don't know. It's never happened before. China and Russia and there's the BRICS currency that people are scared of. They say, aren't you scared of this? I said, well, they created this euro. And they did this 30 years ago. It was a ton of work. And these countries have to agree to it, and they submit to it. And they have to trust each other. So when Greece does something stupid, everybody else bail Greece out. And it's just very tenuous all the time. And this is Europe, where everybody gets along.
Is that not Greece?
Well, nothing on Greece. What I'm saying is that these people are as cohesive as they can be. Right. That China and Russia could ever agree to do anything together, it doesn't occur to me as realistic at all. I just think, they can't trust each other further than they can shoot each other. But I think it's all of these things are theories. Like people are predicting these apocalyptic type outcomes, but it doesn't connect for me. And so it does occur to me that the world has gone through tremendous amounts of uncertainty, and always when you look at it over 10-year, 20-year, 30-year periods of time, it's always been, the markets have always recovered.
So use the science to follow that instead of guessing and worrying, because it's no way to live.
And then focus on and then investing, I think, can give you a resource that can resource your purpose in ways that are really amazing. Yeah, Judy.
Do you have different strategies depending upon the age of the investor?
Yes, it's not one size fits all. So age is a risk tolerance. We call it sleep factor. Some people just don't want to take as much risk. That's okay. I mean, just know what that is, and so we can map out what the expected volatility is based on different mixtures of assets. So if you can't handle the volatility of an aggressive portfolio, we can make that less volatile. By adding more bonds or fixed income to your portfolio, owning less stock. And every client we talk to, we have a conversation about risk that's appropriate for them in their situation. And so,
I don't know if this is going to help or not, but I'm curious. I've got some holes or gaps that I'm trying to fill with that strategy and fitting to the people's particular need. Is there some avenue of using the old method to pick out what has the particular investments that you use tending to perform at, and how you create that strategy or that mix that's going to fit the particular client's risk tolerance and goals that they're searching for in what they're planning to use their money for? I feel kind of hesitant to move, as you've noticed, based on maybe some fears or maybe some old school training. But I'm trying to get my head around how to make those changes. I've in some successes in the past, I've been okay, done well, utilizing the old method before the Roth, the 401k. Now I'm caught with conversions, which is a little different than what we're talking about, but I also find it difficult to change my investment mix, follow the new principles, because I feel like I have to convert $60,000 a year for the next 5 years until they become 73 and require minimums kick in.
yeah,
I'm trying to come up with a way to follow the new academic methods, supporting them mentally more and more, but not still grasping the full picture, even with the charts and the help and the time you've given me on a one-on-one, to try to see how that's going to look, project that out based on, again, my old school training and thinking on what are these mix of investments going to bring me, both value and growth-wise, to see or make an estimate of where I'm potentially going to be if I do finally turn that corner to take the plunge.
really good. I thank you for being here, and secondly, it's just thank you for continuing to engage, because Gary's and my conversations. I mean, you were up to your eyeballs inside of the traditional investing model, and dispelling those. It takes something to hear that and then hear it again and hear it again. So I want to first acknowledge that. Secondly, is there is I think a decision order that might be helpful. We've talked about this before, and I'll put it.
Well, I don't want to hold it.
No, but it's simple. The decision order. There's 3 things to decide, and I think what Gary's getting at is, I'm not going to write it down. I'll just share it. The first thing is decide what world of investing you want to be in. And so there's the traditional investing and the academic, and it takes a little bit of time, and it's a process for understanding. And I think what you're saying is that it's landing more and more. It takes a little bit. But once you decide and say, hey, the traditional investing model occurs to me like speculating and gambling. It occurs to me as absurd. Nobody can pick stocks. I get that, and I didn't see that before, but now I see it everywhere. So when you first you acknowledge that, then next is take a look at the level of risk. What's the appropriate level of risk for where I'm at? And different people are in a different place. Judy's in a different place than I am for risk, and so establishing what's the appropriate level of risk is going to determine really where you're at with stocks and bonds, and how much you're risking. If you're a lot of individual stocks, there's a lot of risk there, just a tremendous amount of risk. An individual stock, I don't care how long they've posted positive returns, can fail, and there's been tremendous examples of that. the largest airline company and the airplane company, building company in the world, builds planes that crash themselves, right? I mean, what does that do to the stock, right?
It isn't just turning the corner, it's biting the bullet for the expense of getting out of
third one-
stocks or any of the other things that cost you every time you.
The third one is what Gary's talking about, and that's capturing a lot of your time. That is the taxes that getting out of individual stocks that you've owned since the 70s and 80s leaves you with some taxable gains and things. And so, how do we do that to minimize the taxes, minimize the cost, to really maximize your investment? And so, I mean, and that's something we do carefully and step by step. It's not something you do wholesale all at once. This is not permanent, right?
I don't think so. No.
Okay,
Yeah,
good.
we're good. I'll try to raise that.
Ruin just ran. So if you bought, let's say you had $500,000 of any stock, and it grew by $500,000, right? Now you've got a stock that's worth $1 million. One stock. What's your capital gains? This is the cost. And this is the gains, right? If you sold that and you're paying 20% capital gains, how much capital gains would there be on that 500,000? You'd lose $100,000, and now you'd have 900,000, right? Is that fun? Right? Boeing stock. Let's say you had 100% gain in Boeing stock, and they start crashing planes, and the price of the stock drops 60%, right? What happens to your $1 million? $400,000. So I guess when you own one stock, what I'm saying is that, yes, there is a tax rate, and there is a way to be careful in managing that, depending on, and there's ways of giving, and there's other things that you can do to try to minimize that. I'm just saying that once you determine that I'm going to adhere to the academic science, the risk of individual stocks and things just isn't, and you start to look at your risk tolerance, then we make strategic decisions, but not all of your portfolio has experienced those kind of gains. There's only a handful of them. Many of them have, and so those are things that we can do strategically to maximize that. But the point is that capital gains taxes haven't always been here. There was a day when everything was income tax. It could go back there. In some sense, capital gains is a gift. There's a lot of people complaining that rich people shouldn't get capital gains. That's a welfare for the rich. So that if this is true, and you have to pay capital gains in order to minimize the risk of your portfolio, and this is possible if you don't, then it doesn't seem like this is as big a hit as, wait till the stock goes down 50%. Then you've got no capital gains and you're free. Isn't that wonderful? That's not what I want.
That's
I don't want that for you. I don't want that for the families. I don't want that for ministry and education. What I want is pay some taxes, get your portfolio in a place where you can capture market returns, you get a peace of mind. We'll evaluate the risk so it's appropriate for Judy or for Candy or for anybody else that's looking at their portfolios, and then we'll take a look at optimizing it for cost and for taxes and making sure that works to it. So it's certainly not a one size fits all, and everybody's situation is all unique, and we work with that very carefully. But if your questions are good, and I think you keep wrestling with it, you're in a good place. So.
Well, in the interest of time, it's been an incredible event. And if anybody wants to hang out afterwards and have more questions for Steve, please feel free to do that. But I want to wrap up the event and allow our videographer to wrap up and all of that. So thank you guys so much for coming out. Incredible questions. Thank you for participating. And
Great group.
yeah,
Thank you.
it was a lot of fun. Thank you, Steve. Again.
No.
No. One more thing I wanted to